The easiest way to understand an economy is to begin with its size. Not because size tells you everything, but because it tells you where a country sits in the world. And Thailand sits in an interesting place. Large enough to matter, small enough to depend on others. Its total economic output, just over $500 billion, places it among the top economies globally, but not among the dominant ones. It doesn't shape the global system. It moves within it. And that distinction matters. Because countries of this size don't control the direction of trade, they respond to it. They don't dictate demand, they absorb it. They don't set global trends, they adjust to them. Thailand's economy grew into this position over decades, not through sudden breakthroughs, but through steady accumulation. Factories, infrastructure, trade relationships, tourism networks. Layer by layer, year by year, it built something stable, something functional, something that works. But size alone can be deceptive, because being large doesn't mean being powerful, and being stable doesn't mean being resilient. Thailand's position, second largest in Southeast Asia, gives it regional weight. It influences its neighbors. It participates in global supply chains. It attracts investment. But it also means something else. Is deeply exposed to global demand, to trade flows, to economic cycles it does not control. And that exposure is the thread that runs through everything. Because once you understand where Thailand sits, you begin to understand what it depends on. If size tells you where an economy stands, growth tells you where it's going. And this is where the story begins to shift. Because Thailand is still growing. Just not the way it used to. There was a time when 4, even 5% annual growth felt normal, expected. The kind of pace that builds confidence, not just for investors but for businesses, workers, and governments. Growth at that level creates momentum. It allows mistakes to be absorbed. It makes debt manageable. It hides inefficiencies. But today, that momentum has slowed. Growth now hovers closer to 2%, sometimes lower. Forecasts suggest it may slow even further. And that change is more important than it first appears. Because economies are built on expectations. And when growth slows, expectations shift. Businesses become cautious. Consumers hold back. Investment decisions change. And over time, that caution becomes self-reinforcing. A slower economy begins to expect slow growth. And once that mindset takes hold, it becomes difficult to break. What makes this more complicated is that Thailand hasn't collapsed. There's no crisis driving this slowdown. No single event you can point to and say, this is where everything changed. Instead, it's gradual, structural, the kind of shift that happens quietly. A little less growth each year, a little less momentum, a little more dependence on external forces. And over time, those small changes accumulate. Until one day, you realize the trajectory is different. Not broken, just slower. And slower growth doesn't just affect numbers. It affects everything built on top of them. Wages, investment, opportunity, and perhaps most importantly, confidence. There's another way to measure an economy, not by its total size, but by what that size means for the people living inside it. And this is where GDP per capita comes in, because it answers a simple question. How much economic output exists per person? In Thailand's case, that number sits just above $7,000. Higher when adjusted for purchasing power. Enough to provide stability. Enough to build a middle class. But not enough to reach the level of advanced economies. And that places Thailand in a very specific category. Not developing, not developed, something in between. This is often called the middle income stage. And it's one of the most difficult phases for any economy to navigate, because the advantages that drove early growth begin to fade. Low-cost labor becomes less competitive. Basic manufacturing becomes easier for other countries to replicate. And at the same time, moving into high-value industries, technology, innovation, advanced services requires something more. education, investment, productivity gains. And those things take time. This is what creates the middle income trap. Not a sudden failure, but a plateau, a slowing of upward movement, a point where progress becomes harder and more uncertain. Thailand has reached that point. Its people are no longer poor, but the path to becoming fully developed is not guaranteed. And this is where pressure begins to build, because expectations rise with income. People expect better wages, better services, better opportunities. But the economy must evolve to meet those expectations. And if it doesn't, tension begins to form. Quiet at first, but persistent, because an economy can remain stable for a long time, even while slowly falling behind. Inflation is often described as a warning signal. When it rises too quickly, it suggests an economy is overheating. Too much demand, too much spending, too much pressure building inside the system. But what happens when inflation doesn't rise at all? When prices stay flat, or even begin to fall? That's the situation Thailand has found itself in at times. Periods where inflation drifts toward zero, even dips into negative territory. At first glance, that might sound like a good thing. Stable prices, affordable goods, no visible pressure. But in reality, it often points to something deeper. Weak demand, consumers holding back, spending delayed. Because inflation doesn't just measure prices, it reflects behavior. And when people stop spending or spend more cautiously, the entire system begins to slow. There's a subtle psychology behind inflation. When prices are rising, people tend to buy sooner, before things become more expensive. But when prices are stable or falling, there's no urgency. People wait. They delay purchases. They become more selective. And that hesitation spreads. Businesses notice. Sales slow. Inventory builds. Investment decisions get postponed. And slowly momentum fades. In Thailand's case, inflation hasn't disappeared entirely. Forecasts suggest it will return to more typical levels. But the periods of near-zero inflation reveal something important. The economy is not under pressure from excess demand. It's operating below potential. Quietly, calmly, but not fully engaged. And that kind of calm can be misleading, because it doesn't feel like a problem until it lasts too long. If inflation tells you how people are spending, unemployment tells you how people are working. And in Thailand, this is where the numbers seem almost too good to be true. An unemployment rate below 1%, among the lowest in the world. At face value, it suggests something remarkable. A fully employed economy. A labor market with almost no slack. A system where nearly everyone who wants work has it. But like many things in this economy, the surface doesn't tell the full story. Because employment is not the same as security. And it's not always the same as productivity. Thailand has a large informal sector. A space where people work, but not always in structured, stable jobs. Street vendors, small family businesses, freelance labor, seasonal work. These are real jobs. They provide income. They sustain livelihoods. But they often lack consistency, benefits, long-term stability, and most importantly, high productivity. This creates a kind of illusion. On paper, unemployment is low. But beneath that, underemployment exists. People working, but not reaching their full economic potential. And when that happens across an entire economy, it limits growth, limits income, limits upward movement. Because an economy isn't just about how many people are working. It's about what that work produces and how much value it creates. When growth slows and demand weakens, central banks step in, not dramatically, not visibly, but through one of the most powerful tools they have: interest rates. Lower rates make borrowing cheaper. They encourage spending, encourage investment, encourage movement within the economy. And in Thailand, rates have remained relatively low. A deliberate choice, a quiet attempt to support momentum. But low interest rates carry a message. They signal that the economy needs help. That demand isn't strong enough on its own. That without support, things may slow further. And over time, this creates a dependency, an environment where growth relies not just on real activity, but on financial conditions. There's also a limit to what low rates can do. They can encourage borrowing, but they can't force confidence. They can make money cheaper, but they can't guarantee it will be used productively. And if the underlying economy isn't generating strong opportunities, cheap money alone isn't enough. When growth slows and interest rates fall, another force begins to rise. Government debt. Not immediately dangerous, not dramatic, but steady. Thailand's public debt has climbed to around 65% of its total economy. Manageable. By global standards, even moderate. But the direction matters more than the level, because debt behaves differently depending on growth. In a fast-growing economy, debt becomes easier to carry. The economy expands around it, absorbs it, reduces its relative weight. But in a slow-growth environment, debt becomes heavier, harder to manage, more persistent. Governments often use debt to support the economy, spending more to offset weak demand, running deficits to keep activity moving. And in Thailand, that has been part of the strategy. But debt is not a solution. It's a tool, one that buys time, pauses, and time only matters if it's used to adapt, to evolve, to strengthen the underlying system. Because without that, debt doesn't disappear. It lingers, growing slowly, quietly, just beneath the surface. Governments step in when economies begin to slow, not always visibly, not always dramatically, but through spending, through deficits, through decisions that push money into the system when private demand begins to weaken. Thailand has followed that path, running consistent fiscal deficits, spending more than it collects to support economic activity. These deficits are not extreme. They are measured, controlled, but they are persistent. And persistence is what defines their impact. Because a deficit is not just a number. It is a signal that the economy requires support to maintain momentum. That growth is not fully self-sustaining. That without intervention, activity may slow further. In the short term, this approach works. Public spending fills gaps left by cautious consumers and hesitant businesses. Infrastructure projects move forward. Programs are funded. Economic activity continues. But deficits do not exist in isolation. They accumulate, year after year, adding to the broader structure of debt. And while manageable in a stable environment, they create pressure over time. There's also a deeper limitation. Government spending can support an economy, but cannot redefine it. It can stabilize demand, but cannot create long-term transformation on its own. And this is where the question becomes more complex, because sustaining growth is not the same as creating it. And over time, that difference becomes increasingly important. Thailand's economy does not operate in isolation, is deeply connected to the world. More than half of its total economic output is tied to exports. Goods produced domestically, consumed elsewhere. Electronics, automobiles, agricultural products, components that move through global supply chains before reaching their final destinations. This level of export dependence creates opportunity, access to global markets, exposure to international demand, participation in systems far larger than the domestic economy. But it also creates vulnerability, because demand is not controlled internally. It is determined elsewhere, by economic conditions in distant countries, by shifts in global consumption, by forces that Thailand cannot influence. When global demand rises, exports increase, production expands, growth accelerates. But when global demand slows, the effect is immediate. Factories reduce output, orders decline, economic momentum weakens. This dependence creates a kind of external rhythm. Thailand's economy moves not entirely on its own cycle. but in response to the world. And that rhythm is becoming more unpredictable. As global trade shifts, as supply chains evolve, as competition increases, countries with lower costs emerge, others with more advanced capabilities move ahead, and Thailand sits in the middle, balancing between them. Exports are only one side of the equation. Imports complete the picture, and together they form the trade balance, the difference between what a country sells to the world and what it buys in return. Thailand's trade balance has shifted over time, sometimes positive, sometimes slightly negative, fluctuating with global conditions, with currency movements, with changes in demand. A surplus suggests strength, more goods leaving than entering, a net gain in external demand. A deficit suggests the opposite, more reliance on imports, more money flowing outward. But in Thailand's case, the balance itself is less important than what drives it, because fluctuations are not random. They reflect deeper dynamics, changes in global demand, shifts in domestic consumption, movements in currency value, each adjustment small on its own, but meaningful over time. The trade balance is not a fixed state, it is a reflection, a mirror of how an economy interacts with the world. And in Thailand's case, that interaction remains active, but increasingly sensitive. There is another force within Thailand's economy, one that does not move through factories or shipping ports, but through people, tourism. For years, it has been one of the most powerful drivers of economic activity, a steady flow of visitors arriving from around the world, filling hotels, restaurants, transportation networks, local businesses, entire regions built around their presence. At its peak, tourism accounted for a significant portion of Thailand's total economy, not just directly, but through everything connected to it: employment, services, supply chains supporting hospitality. And when tourism flows freely, the impact is immediate. Growth accelerates, income rises, confidence builds. But tourism is also fragile. It depends on movement, on confidence, on global stability. When travel slows or stops, the effect is just as immediate in the opposite direction. Activity declines, businesses struggle, entire sectors feel the absence. This creates a dual reality. Tourism can drive rapid growth, but also introduces volatility, because it is not fully within domestic control. It responds to global conditions, to perceptions, to events far beyond Thailand itself. Beneath the broader structure of the economy, there is another layer, one that doesn't always show up in growth numbers, or trade balances, or government policy, but one that quietly shapes how an economy actually feels to the people living inside it: household debt. In Thailand, this number has risen steadily over time, climbing into levels that are high by regional standards, approaching a point where it begins to influence behavior, not just reflect it. Because debt is not just a financial measure. It is a constraint on spending, on risk-taking, on everyday decisions. When households carry significant debt, they adjust. They become more cautious, more selective, less willing to spend beyond what is necessary. And when that happens across millions of people, it begins to shape the entire economy. Consumption slows, demand weakens, growth becomes harder to sustain. There is also a psychological effect. Debt changes how people think about the future. It introduces hesitation, a focus on repayment rather than expansion, stability rather than opportunity. And over time, that mindset becomes embedded, not as a reaction to crisis, but as a quiet adaptation. Thailand's economy, in many ways, reflects this. Not unstable, not collapsing, but restrained, operating within limits that are not immediately visible, but constantly present. And this is what makes household debt particularly significant. It does not trigger sudden events. It does not create dramatic headlines. It works slowly, reducing flexibility, reducing momentum, making recovery more difficult even when conditions improve. Because even when opportunities return, highly indebted households cannot always respond. They are already committed, already constrained, already focused on maintaining balance. And so the economy moves forward, but with less energy, less acceleration, less room to expand. If household debt represents a constraint, foreign reserves represent stability. Thailand holds a significant level of foreign exchange reserves, hundreds of billions of dollars, a buffer, a safeguard, a layer of protection against external shocks. These reserves serve a critical purpose. They allow the country to defend its currency, to stabilize financial markets, to manage volatility when global conditions become uncertain. And in a world where capital moves quickly, that stability matters, because economies that are deeply connected to global trade are also exposed to global financial flows, currency pressures, investor sentiment, external risk, and when those forces shift, countries without sufficient reserves can face rapid instability. Thailand does not fall into that category. Its reserves provide confidence, a sense that, even in difficult conditions, the system can hold. But reserves, like many things in this economy, are defensive. They protect, they stabilize, they reduce risk, but they do not create growth. They do not generate momentum. They do not solve structural challenges. They ensure that problems do not escalate quickly, but they do not prevent those problems from existing. And so the picture becomes more nuanced. On one hand, stability. On the other, limitation. An economy that can withstand shocks, but still must find a way to move forward. To understand how an economy functions, it helps to look at what actually produces its output. In Thailand's case, that production is spread across three primary sectors: industry, services, and agriculture. Industry plays a major role. Manufacturing, automobiles, electronics, production that feeds directly into global supply chains. This sector has been a foundation of Thailand's growth for decades, a source of exports, a source of employment, a source of integration into the global economy. Services now represent the largest share. Tourism, finance, retail, logistics, activities tied not just to production, but to movement, to interaction, to consumption. And then there is agriculture, smaller in economic share, but still significant in cultural and social terms. A sector that supports livelihoods, provides exports, and connects the economy to its historical roots. Together, these sectors form a balanced structure. No single pillar dominates entirely. Each contributes, each supports the others. But balance does not always mean strength, because each sector faces its own pressures. Manufacturing faces global competition. Services depend on demand and mobility. Agriculture remains vulnerable to environmental and market conditions. And as these pressures evolve, the balance itself becomes more difficult to maintain. The challenge is not just to sustain these sectors, but to move them forward, to increase productivity, to create higher value, to transition toward more advanced forms of output. Because without that evolution, balance can become stagnation, a system that holds together, but does not progress. In the long term, no force shapes an economy more quietly or more powerfully than demographics, population size, age distribution, the balance between those working and those no longer in the workforce. Thailand's population is no longer growing the way it once did. The pace has slowed. The structure has shifted. The median age has increased. And with that, the economy begins to change. An aging population introduces new pressures. Fewer workers entering the labor force. More individuals moving into retirement. Greater demand for healthcare, for support systems, for stability. At the same time, economic growth becomes harder to sustain, because growth depends in part on expansion. More workers, more production, more activity. When that expansion slows, Growth must come from somewhere else. From productivity, from innovation, from efficiency. And those are harder to achieve. They require investment, time, transformation. This is where Thailand's long-term challenge becomes most visible. Not in any single number, not in any single year, but in the direction of the system itself. Because an aging economy can remain stable. It can function. It can sustain itself. But without adaptation, it can also slow, gradually, persistently, almost imperceptibly at first, until the difference becomes clear. And so the story of Thailand's economy comes into focus. Not as a story of crisis, not as a story of failure, but as a story of balance under pressure. An economy supported by exports, but dependent on global demand, strengthened by tourism, but exposed to external shifts, stabilized by policy, but limited by structural constraints. A system that works, but must evolve, because the future will not be determined by whether Thailand can maintain stability. It will be determined by whether it can move beyond it, whether it can transition from balance to momentum, from stability to growth. And that question remains open.